Hello everyone and welcome back, it's Chris. In this video I want to show you 17 companies, 17 stocks that can create 20% returns for the coming years. We are talking about exemplary companies that are growing their fundamentals very positively, growing their free cash flow per share in a very nice way. And I believe if you can buy them at a reasonable valuation, you can compound at 20, 22, 25% per year. You just have to find them at a reasonable price. And if you fill your portfolio with some of them, you increase your chances of outperforming the market. So in this video, I want to talk about a great Twitter post from Long Equity that says Visa, MasterCard, FICO, and MSCI have all compounded their free cash flow per share by 20% over the last 15 years. But it's not just the anti-fragile fintechs that have achieved this, so has the storage company Extra Space Storage. Which one of the list do you own? Great Twitter post. And in this video, I want to give you some tips how you can find these businesses and how to invest if you want to focus on these companies. In case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And the goal with this YouTube channel is to help you become a better investor. And I love this post, and I wanted to share it with you because I am a shareholder of some of these companies, and I have generated 25% per year because I specifically invested in these companies. Okay, so in this list, you have 17 companies. I believe the 17 companies here are worth a deep dive. In case you want to make 20-25% per year, I would highly recommend you make a huge deep dive on these companies. All of them. Just giving you some homework to start this video. These are maybe some of the highest quality stocks available out there. Some of these companies are hard to follow. Some of these companies are very simple to follow. I mean, you have Apple, right? So you have a few companies on this list, and currently in my portfolio, I have some of them. I have Fortinet, I have Fair Isaac, I have MSCI, I have MasterCard, and I have Adobe. But there are some other simple businesses in this list. You have Union Pacific, a very simple business to understand if you want to start the research here. You have Domino's Pizza, a very simple business to understand. Be careful, you have different Domino's Pizza. You have the branch in the US, in the UK, in Australia, in also Poland. So only look at the US company. The other ones are more difficult to analyze. You have Lowe's, you have Apple, very simple companies to analyze. There is one particular thing that I love about all these businesses. The first one being they are focused on growing their free cash flow per share. One of the elements of this is the free cash flow. Okay, you want these companies to grow their cash. What is the real profits, the real cash these companies generate? We are not talking about adjustable earnings. We are not talking about revenue or any quality metrics. No. Free cash flow. This is the most important metric if you want to follow Warren Buffett. And yeah, you want to be invested in companies that can grow their free cash flow for a sustainable period of time, like this 15 years. And you want them to grow free cash flow at double digits, 10, 15, 20%. For all the stocks available out there, all the companies available in public markets, very few of them will be able to grow free cash flow at 16% per year for 15 years. You can remove, boom, all the bad apples. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. You want to stay invested in winning companies, because winning companies like this, they have an edge, they have a moat. You don't need to be a genius. You don't need to find the next Amazon in investing. You can just spot winners that have a moat, that have a monopoly, duopoly, and when they drop in price for some reasons, you buy them. This is exactly what Warren Buffett has done with Apple in 2016. The stock price dropped, Ted Weschler bought, and in 2018 the stock price dropped, Warren Buffett bought meaningfully, and Warren Buffett made a fortune out of Apple because Apple was focused on cash. They are not investing massively in capex. They are not making stupid acquisitions. They stay in their lane and they want to increase prices, increase volumes, sell more and more quantities to generate as much cash as possible. And all of these companies want to generate as much cash flows as possible. The second element of the equation, free cash flow per share, is the per share measure. Some of these companies available out there will generate 15% growth rate in free cash flow, but they will maybe dilute shareholders. Actually, a sound way to invest would be to repurchase your shares. The majority of these companies here are doing buybacks. Apple is the most famous example. All the free cash flow per share they have generated was used to fund buybacks. They repurchased their own shares. The same thing is true for MasterCard. The same thing is true for Fair Isaac, MSCI. Fortinet is doing massive buybacks. The majority of these companies are famous for doing buybacks. And if you are generating, let's say, 15% free cash flow per share, free cash flow every year, if you generate even 20% could work actually. Let's say you generate a growth rate of free cash flow of 20% per year. The business is stable. You are a monopoly in the US, that's fine. If you repurchase 3-4% of your shares every year, you go from a growth rate of 20 to 24%. Well, this is exactly what Fair Isaac has done. FICO has done this for many years, and everything has accelerated since 2018. So now we can look at the 15-year CAGR. Actually, the real growth rate you can look at for Fair Isaac is the growth rate since 2018. You will see that this line is not 20%. It's much higher than this, but I will let you do some homework so you can do it at home. All these companies are growing free cash flow per share meaningfully because all these companies have a moat. So if you want to find these opportunities in the market, one, you can look at these 17 stocks and do the research. Two, you can put several elements in a screener. The best screener I have found is the screener from Fiscal AI. You have a link in my description to try the website completely for free without putting your credit card. Just click the link in the description and create your own account. You can put several things. Free cash flow growth of 15% per year, some buybacks, 1, 2, 3, 4% buybacks. So the free cash flow per share should be growing at more than 15% per year. Also, a second element to find winning companies with a moat is to look for high return on invested capital, a high ROIC. It's a measure for efficiency. You can look at all the companies. Companies with a moat will have a ROIC above 15% per year. Okay? So you have two criteria, and that's it. That's very simple. Free cash flow per share growth above 15% per year, and a ROIC for the past 10 years, 20 years, above 15%. You will see plenty of results, winning companies, and now that's where the tricky question comes. When do you buy? You want to buy when they are cheap, right? You don't want to buy these exemplary companies when they are trading at stupidly expensive valuations. A couple of quarters ago, Fair Isaac had a PE ratio of 100. You don't want to touch PE ratios of 100 at all. You want to buy them when they are cheap. But the time to do the research is before. You want to do the heavy lifting, the research, the due diligence when they are at an expensive valuation. You will be more rational, you will highlight the risk, etc. So when these stocks drop in price, you come prepared. You don't panic buy without having done the due diligence. And by the way, this is exactly what I just did for FICO, for Fair Isaac. I know the company quite well. I did a lot of research, and the stock recently fell a lot, fell 40%. So I just bought the dip. And in my portfolio, I did the exact same thing for Fair Isaac, MSCI, I bought the dip, MasterCard, I bought the dip, Fortinet, I bought the dip, Adobe, I bought the dip. Okay, now Adobe is getting some doubts. People doubt and they think the business will die. Fair enough. The valuation is really cheap. You have the opportunity to buy the dip. Maybe the business will get disrupted and I will lose. Or maybe the business will fight back and I will make 20% per year. Fine with me. I like the odds. It's all about risk reward and conviction. So I have my favorites out of the list. But these are 17 companies that are worth your time. I can guarantee this 100%. You don't grow your free cash flow per share by this much without having something special, right? All these companies, they have a moat. All these companies are quality. All these companies have a quality management team. So all these companies are worth your time. And I want to help my audience find the best stocks so you can finally outperform the market. If you are looking for opportunities, these are 17 stocks to monitor. Davita may be a little bit technical for the majority of people. Transgym is wonderful. Lowe's is wonderful. Domino's Pizza is wonderful. Adobe is extremely simple to understand. Union Pacific, extremely simple to understand. Tyler Technologies, a little bit more technical, I would say. Extra space storage, quite interesting. Fortinet, extremely interesting. So maybe what is highlighted in green should be your starting point. Maybe you can also start with Domino's Pizza and Lowe's, very simple to understand. And once you are done, you can look at the rest. But before looking after the next Amazon, the next golden opportunity, these are 17 stocks that can generate 20% per year. They are here in front of your eyes. And you do the research, you analyze them thoroughly, you see if this is something inside your circle of competence or not, if you really understand the business model. And out of these 17, maybe you will understand 6. That's fine. You put the 6 of them on your watch list and you wait. You wait for a reasonable price. And when the stock price drops or when the valuation drops, you buy them and you hold because the track record will help you. Once you have bought the dip, you can just monitor them from a distance, but we are talking about winning companies. So most of the time, winning companies will keep on winning because they have a moat. FICO is a monopoly. Visa and MasterCard, duopoly. MSCI, oligopoly. Fortinet, oligopoly. We are talking about companies that have something special. And if you fill your portfolio with winning companies like this that are focused on growing the free cash flow per share, you increase your chance of outperforming the market and you increase your chances of making 20 to 25% per year. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.